Welcome to our deep dive on the tenant trap and how below-market rents can decimate an investment property's value. Today we will unpack why value drops under rent control, how your buyer pool changes, and which strategies can protect your equity. To begin, let's look at our agenda so you know exactly what's coming next. In this video, we will cover 9 parts. The big idea, why value drops, how the buyer pool shrinks, 3 strategic options, the mandatory legal step, decision flow and timeline diagrams, a numbers example and checklist, a short quiz, and the key takeaways. Next, let's set the stage with the core concept behind falling valuations when rents are far below market. Here is the big idea. Investors value properties based on projected cash flow. In cities with strict rent control and just cause eviction, a buyer often cannot raise rents to market in the near term. As a result, the capitalization rate looks weak, and the property's price must fall to compensate. In other words, the legal constraints delay income growth and force an occupancy discount. With that foundation, let's immediately add an important disclaimer. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Laws and regulations around rent control, tenant protections, and evictions vary widely by city and county. Before acting, consult a qualified local real estate attorney and appropriate licensed professionals. Now, with that in mind, let's examine exactly why value drops when rents are far below market. Investors typically apply the formula value equals income divided by the cap rate. When current rents are far below market, net operating income is depressed. Under rent control and just cause eviction, a new owner may be legally unable to raise rents quickly. That delay weakens the near-term return profile. To compensate, buyers lower the price or increase the cap rate they require, pushing value down. Additionally, buyers price in legal complexity and time risk, which further expands the discount. Now that we understand the mechanics, let's see how this reality shrinks the potential buyer pool. When a unit is tenant-occupied, owner-occupant buyers are usually out of the picture, especially in strict rent control areas. That leaves mainly seasoned landlords and value-add investors who understand the rules. However, the smaller buyer pool reduces competition and leverage for the seller. Even these experienced buyers will demand a discount to address the lack of immediate cash flow upside. Having established the buyer dynamics, let's compare the main strategies you can pursue. You have 3 broad paths. First, sell the property occupied for a faster sale but at a steeper discount because the buyer cannot rapidly realize market rents. Second, hold the property and hire a property manager if tenants are reliable, thereby converting the asset into passive income while you wait for better market or regulatory conditions. Third, if local rules allow, wait for the leases to end so you can deliver units vacant and attract a broader buyer base with much stronger pricing. To help you choose among these, let's visualize the decision logic with a flow diagram. This flowchart helps map decisions to outcomes. We begin with your primary goal. If you need quick cash and cannot legally raise rents soon, selling occupied at a discount becomes the practical outcome. If you can raise rents within a reasonable time and tenants are reliable, holding with a property manager may be optimal. If tenants are not reliable, but local rules permit waiting, allowing leases to expire can position you for a stronger exit price. A risk tolerance checkpoint considers whether you are comfortable with legal complexity and time delays. Depending on that tolerance, you either proceed with holding or waiting, or revert to selling now with a price adjustment. Next, let's quantify the impact with a simple numbers example. This simplified example assumes a 4-unit property, where market rent is $2,000 per unit, but current rent is $1,000. Annual gross at market would be $96,000, and at current rents, $48,000. Assuming expenses at 30%, the NOI at market is $67,200, and at current rents, $33,600. At a 6% cap rate, value drops from approximately $1,120,000 to about $560,000. Buyers may also demand an additional occupancy discount for risk and time delay, here shown as 10%, resulting in a hypothetical contract price near $504,000. These figures are illustrative only. Actual expenses, cap rates, and discounts vary by market and legal conditions. With the numbers in mind, let's move on to concrete steps you can take right now. Start by gathering key documents including leases, rent rolls, payment history, and expense records. Next, consult a local landlord-tenant attorney to confirm applicable rent control and just cause rules. request tenant estoppel certificates to verify lease terms. Then, model multiple scenarios comparing current versus market NOI, cap rates, and pricing outcomes. Evaluate tenants for reliability and maintenance profile. With that analysis, choose a strategy. Sell occupied now, hold with a property manager, or wait for lease expiration if allowed. Prepare the property with necessary maintenance, disclosures, and compliant notices. And tailor your marketing to seasoned investors or the general market depending on your approach. Now, let's reinforce your understanding with a quick quiz. Quiz time. Question. In strict rent control markets, why do buyers demand an occupancy discount on tenant-occupied properties with below-market rents? Option A. Because renovation costs are always higher in older buildings. Option B. Because the buyer cannot reliably raise rents to market quickly, delaying cash flow and worsening the cap rate at the same price. Option C. Because lenders prohibit loans on tenant-occupied properties. Option D. Because property taxes automatically rise when tenants are present. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is because the buyer cannot reliably raise rents to market quickly, delaying cash flow and worsening the cap rate at the same price. The regulatory delay on rent growth weakens the near-term return profile, which buyers reflect as a lower purchase price. Next, let's test your understanding of strategy selection. Second question. Which strategy typically maximizes final sale price when legally permissible and practical? Option A. Sell occupied immediately. Option B. Hold long-term with a property manager. Option C. Wait for leases to expire and deliver units vacant to the open market. Option D. Offer tenants cash for keys without consulting an attorney. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to wait for leases to expire and deliver units vacant to the open market. This approach usually broadens the buyer pool and strengthens pricing, assuming it is legally permissible. Now let's emphasize the mandatory legal step before you choose any path. Before making any decision, consult a local real estate attorney with landlord-tenant expertise. Verify the exact rent control rules, just cause eviction protections, relocation assistance obligations, and notice requirements. Confirm whether owner move-in or other grounds are lawful in your jurisdiction and situation. Finally, align your timeline and strategy with the legal path to avoid missteps that can be expensive and time-consuming. With the legal foundation set, let's visualize how a lease wind-down could look on a timeline. This Gantt-style timeline shows the sequence. First legal review, then issuance of compliant notices, followed by staggered lease expirations by unit, turnover, and light refresh work, and finally the marketing and sale phase. Dependencies ensure you do not begin turnover before leases end, and you do not market a unit as vacant until lawful vacancy occurs. Timelines vary by jurisdiction and lease terms, so treat this as a framework rather than a guarantee. Next, for practical execution, let's give you a quick checklist you can copy. Use this copy and paste checklist to keep your process organized. First, gather documentation, then meet with a local landlord-tenant attorney to confirm rules. Request tenant estoppels, underwrite multiple scenarios, and build a 12 to 18-month calendar reflecting legal milestones. Finally, choose your strategy and align your marketing and pricing accordingly. To reinforce visual learning, let's include another diagram of the value mechanism. This diagram recaps valuation mechanics. Price today is essentially today's NOI, divided by the buyer's required cap rate. Rent control and just cause protections reduce near-term NOI and extend the path to market rents. In response, buyers often add a risk premium, elevating their required cap rate and reducing the price they are willing to pay. With mechanisms and steps clear, let's consolidate what matters most. The essential points are these. First, below-market rents combined with strict regulations weaken near-term returns and reduce price. Second, a smaller buyer pool further compresses offers. Third, your main strategies are selling occupied, holding with management, or waiting for vacancy. Fourth, local law determines what is possible and when, so attorney guidance is essential. Finally, model multiple scenarios numerically to make an informed, defensible decision. Now, let's wrap up and send you off with a clear call to action. To summarize, income ultimately drives value, and local rules determine the timing of income growth. When selling occupied under strict rent control, expect an occupancy discount. If feasible and lawful, waiting for vacancy tends to maximize sale price. Alternatively, delegate to a property manager if you prefer passive holding and long-term appreciation. Above all, consult a local attorney before issuing any notices or entering negotiations. Finally, here's a quick closing request to support the channel and continue the conversation. Thank you for watching. If you found this helpful, please like the video, share it with someone who might benefit, and subscribe for more real estate breakdowns. What is your biggest challenge with rent-controlled properties? Share your thoughts in the comments so we can learn together. See you in the next one.